All right, welcome back and welcome to Chapter 10 on bonds and bond valuation. This is the chapter where we start to put to work all of the things that we've learned in the last few chapters. The whole idea of present value relates specifically to bonds and to stocks. So in this chapter, we're going to look at characteristics of a bond valuation, using something called the yield curve, and then risk of interest rates and defaults. So starting with our first section on characteristics of bonds, we're going to list and define some characteristics of bonds, describe the various types of bonds that are available, and how bond price is inversely related to its return or yield. A bond is something that goes back a long way. What you have here in front of you is a bond certificate, and we'll get into a little bit more detail on what these pieces of the bond certificate represent. And as part of characteristics, we'll look at bonds as investments, some terminology, types of bonds, etc. A bond is an investment that represents a future stream of cash flows that's promised by its issuer, and those issuers can be governments or corporations. Bonds are known as fixed income securities because they provide predictable, regular cash inflows to the buyer of the bond. Depending on the nature of your risk profile, you may prefer riskier securities like stocks, or if you want something a little bit safer and more predictable, you'll tend to focus more on bonds. Of course, bonds typically return less than stocks. Stocks will return more, but they are more risky. So that's why as you get older and shift your portfolio from more risky to less risky types of securities, bonds end up representing more and more of a portfolio as the investor typically ages. And then finally, bonds are essential financial instruments. And there's a lot of unique terminology that's used to communicate their characteristics and functions. And those terms go back a long way. Again, with this certificate, the large piece with all the writing that you can't really see at the top, that's called the bond indenture. That's the part of the bond that basically outlines all of the legal information that includes all of the things I'm going to show you now. Every bond has a par or face value, and that's the principal amount that's to be repaid at the end of a specific period of time or when the bond matures. Bonds are typically sold in $1,000 denominations. They could be sold in $5,000, $10,000, $20,000 denominations, but throughout the chapter and all our examples, we'll use a $1,000 bond as our baseline. The coupon rate is the annual interest rate that's used to calculate the coupon payments. Now, if you look at the lower part of that bond certificate, you'll notice a bunch of these little rectangles. Well, those rectangles are actually perforated coupons. So what would happen is, let's say your grandma invested in the state of Louisiana and bought a $1,000 bond. She would take that bond and she would go to the bank and she'd put it in her safety deposit box because she doesn't want to lose it. And then let's say that this is a semi-annual bond, so twice a year, she would go to her safety deposit box, open it up, and tear one of these little coupons, and then she would walk over to the teller, and she'd present the coupon, and the bank would pay her coupon payment or her interest payment. So now we don't have physical bond certificates anymore. They've all been replaced. They're all done electronically. But these terms stem from the days where there was a bond certificate and these little coupons. So the coupon rate is the interest rate that's used to calculate those payments. And the coupon payment is the regular interest payment based on the par value of the bond and the coupon rate. So the coupon payment is the par value or face value times the coupon rate. The maturity date, of course, is the date that the bond term ends. And that's when the issuer has to repay the principal to the investor. And then finally, the yield to maturity, or YTM, is the discount rate that equates the bond's present value to its price. So YTM is a term that you'll see very frequently along with coupon rate, coupon payment, etc. So there are a number of different types of bonds. The most common ones are government bonds. Those are issued by, of course, governments. They can include treasury bills, treasury bonds, notes, things with varying maturities. Savings bonds are debt securities backed by governments that offer low returns but minimal risk. You may be familiar with Canada savings bonds, but I checked into that and they're actually not sold anymore. I think they were discontinued in 2017, so can't get those anymore. Municipal bonds, or munis, are issued by local governments and they offer slightly higher returns than federal government treasury securities. and are common for municipalities to raise funds for infrastructure types of projects. There are corporate bonds. Those are issued by companies offering higher returns but carry more risk. So what happens is as you move up the ladder from the federal government to provincial to municipal governments and then to corporations, the return increases because the risk level increases. The federal government of Canada or the US, and we'll talk about the US perhaps at a different time, but the likelihood of the Canadian government going bankrupt is very low, whereas the likelihood of a corporation going bankrupt, depending on its creditworthiness and other factors, is higher. So you have to compensate the investor for the level of risk that's involved. Convertible bonds are bonds that can be converted into a number of common shares. So if an investor, let's say, doesn't want to buy stock in a company and wants to kind of test the waters a little bit, they may buy convertible bonds. And then when they see that things are going well with the company, they may, at their option, convert those bonds into common shares. And the company, of course, then doesn't have to pay back the principal at the end because, in essence, it's taken the $1,000 from the investor and converted it into stock later on. Zero coupon bonds are those that are issued at a discount. We'll talk about premiums and discounts. And they repay the full par value at maturity without any periodic interest. You might wonder, well, why would somebody buy a zero coupon bond? Because they're sold at a discount. So what happens is you would pay something less than $1,000 for a $1,000 bond, let's say $900 for a 3-year bond. And at the end, you'll get $1,000. So you will earn $100 on your bond investment. No interest, all capital gain. There are other types of bonds called real return bonds or RRBs. These are long-term bonds and they provide inflation protection. So what happens is they adjust the principal and interest payments according to the Consumer Price Index or CPI. We won't worry about those though. So when we think of the global bond market versus stock markets, essentially the global bond market is larger than the stock market. And that's primarily due to the inclusion of what we call sovereign bonds or international bonds. And despite the bond size, stock markets are growing faster because they're higher returns over the long run. And you have more and more stock markets in developing countries, China stock market, etc. So bonds will always be around, but for investors that are looking for higher return with higher risk, stocks, especially stocks in emerging markets, are more attractive. So there are two sides to an investment in a bond. Bondholders will receive two types of cash flows: periodic coupon payments or the interest income, and they'll receive the principal at maturity. Now what happens is the valuation of bonds involves calculating the present value of both of those coupon payments and principal repayment because those are cash flows that are in the future. So the value of a bond today is actually worth something different than the sum of the interest and the principal repayment at the end. And again, that's why we did all that work in the previous chapters, so that now we're prepared to determine what the value of bonds are. So what we'll discover is that there is an inverse relationship between bond prices and interest rates. So when interest rates rise or fall, the bond price will fall or rise. And we'll see this. There are things called floating rate bonds or FRNs. They have interest rates that are tied to market benchmarks and can reduce some interest rate risk. We're not going to look at those. There are also deep discount bonds. Again, zero coupon bonds are deep discount bonds. They're highly sensitive to interest rate changes, and their lower coupon rates lead to greater price volatility. My example of paying $900 for a $1,000 bond that doesn't pay any interest is probably too high. You might pay $700 or $800 for that bond, and the rest is made up on capital appreciation in the end. All right, now it's time for the fun stuff, valuing bonds. So in this section, we're going to determine the value or the price of a bond, and we'll look at the differences between premiums and discounts. We'll draw timelines. That's why I had you do those earlier, and briefly differentiate between fixed and variable rate bonds, and then determine bond yields. So our emphasis here is on bond pricing, discounts and premiums and yields. So when it comes to pricing of a bond, there's actually two prices. There's what we call the clean price, and that is the basic present value of the coupon payments and principal repayment. So in terms of the types of calculations that you were doing previously on loans, if you wanted to determine the present value of future payments, that would be considered the clean price. The dirty price is the clean price plus the accrued interest since the last interest payment. Because what happens is, if you purchase a bond from me right after the last interest payment, then you will receive the next interest payment and you'll receive the full amount of the interest payment. Let's say it's a semi-annual bond. So if that bond pays interest on June 30th, December 31st, and you purchase that bond on the morning of July 1st, you'll receive the full 6-month interest on December 31st if you hold it that long. But let's say you purchase that bond from me on July 1st, and then let's say you sell it to somebody else on September 1st. Well, July and August have gone. So what happens is the person that buys the bond from you will pay you the present value of the bond on that date plus 2 months worth of interest. And then they will receive the full 6 months worth of interest if they hold that bond until December 31st. If they hold that bond for 2 months, then the person that they sell it to has to pay them 4 months worth of interest to cover them for the 2 months that they paid you for, and then the 2 months that they've held the bond for. And that individual, the third person that holds it like a hot potato, they will get the full 6 months if they hold the bond till December 31st. So as you get closer and closer to the next interest payment date, the dirty price actually increases because the amount of accrued interest goes up as you near the next interest payment. So the general steps involved in determining the prices of bonds include identifying the amounts and the timing of the future cash flows. Thankfully, when it comes to bonds, these are relatively simple compared to some of the nastier cash flows that we saw in the last chapter. We determine the discount rate. Usually that's provided to us. We'll find the present values of the lump sum principal and the annuity stream of the coupons. So those interest payments occur regularly. There's the same amount. They're an annuity. And then we add the present value of the lump sum and the present value of the coupons together, and we get the present value in total. We've been doing this implicitly, where we put in a value for the future value of the lump sum and of the payments. We can actually determine what the present value of the payments is separately from the future value of the bond. So here's an example. Let's say that you have a $1,000 bond that pays a 5% coupon. It's a 10-year bond that pays interest annually, and the yield to maturity is 6%. Here's what the timeline looks like. $50 at the end of every year for the next 10 years. And at the end of year 10, you receive the $50 interest plus the $1,000 face or par value of the bond. What's the present value? Let's see if you remember how to calculate present value with this kind of cash flow stream. So pause the video, see if you can figure it out, and then resume. If you use your calculator, we go from left to right, 10N, 6 IY, 50 PMT, and 1000 FV. You should end up computing PV to be 926.40. And for all of these, your calculator should be in N mode. Now, you'll notice that the present value is 926.40. Well, that's less than the $1,000 face value of the bond. This bond sells at a discount. Why does it sell for less? Well, let's think of it intuitively for a second here. Why would you pay me $926.40 for something that's worth $1,000? Well, you'll notice it comes down to the relationship between the coupon rate, the interest rate that the bond pays, and the yield to maturity that's on the market. The yield on the market is 6%. My bond pays 5%. So in order to entice you to buy my bond, which pays you less interest than other bonds of similar risk on the market, that means that on average, other bonds are paying 6% interest on the market, where the market expectation is that an investor can earn 6% in an investment of similar risk. So in order to entice you to buy my bond, I have to give you a discount. I have to cut you a break. Hence why the price of the bond is less than its face value. As you get closer and closer to the maturity date, what do you think happens to that price differential? As you near maturity, that discount gets smaller and smaller and smaller. So a discount happens when the coupon rate is less than the YTM, or the yield to maturity. We can also say that this bond sells at 92.6, which means 92.6% of its face value. If the coupon rate equals the yield to maturity, that bond sells at par. It will sell at $1,000. And finally, if a coupon rate is higher than the yield to maturity, that bond will sell at a premium, say for example, 107.3. It's not a radio station. And that should also intuitively make sense, because if the market rate is 6%, but my bond pays 8%, you're getting a better return on my bond than the market. So I can charge you a premium. You're going to have to pay more for my bond that pays higher interest than an investment of similar risk on the market. So let's look at each of these very briefly. If we look at a par example, that $1,000 bond with a 6% coupon, 10-year annual payments, 6% yield to maturity, we can prove that the present value is indeed $1,000. 10N, 6 IY, 60 PMT, which is $1,000 face value times the 6% coupon, $1,000 future value, compute PV, guess what? You have $1,000. For a premium example, it's a $1,000 bond, but now the coupon rate is 7%. So in our calculator, we'll go 10N, 6 IY, 70 PMT, so it's $1,000 face value times a 7% coupon, and the same $1,000 future value, compute PV, and you'll get $1,073.60. You'll notice in all of these cases, IY is 6. One of the common mistakes students make is use the coupon rate as the IY. Never, never, never. The only thing you need the coupon interest rate for is to calculate the payment, the PMT. You're going to take that coupon rate, multiply by the face value, determine the payment, then throw the rate away. You will use the yield to maturity as the IY. Perhaps a way to remember this is YTM includes the letter Y, IY, and the calculator includes the letter Y. So let's look at a dirty price valuation example. So let's say on August 1st, 2025, the quoted price of a 4.5% coupon bond payable semi-annually is $990. You can tell that even though the face value isn't mentioned, we're talking about a $1,000 bond here. The last coupon payment was made on March 31st, 2025. So if you buy that bond on August 1st, what's the total price you have to pay for the bond? The $990 represents the clean price of the bond. So that's going to be your starting point. And then what we have to do is add the accrued interest. So in order to determine the accrued interest, we're going to take the $1,000 face value of the bond, multiply by the 4.5% interest rate. However, this is a semi-annual bond, so we must divide by 2. That equals $22.50 for 6 months worth of interest. Now the last interest payment was made on March 31st. So that means April, May, June, July. 4 months of interest have passed since the last coupon was made. Therefore, we have to multiply that $22.50 by 4 to 6 months to give us $15. That's the accrued interest. So the dirty price on the bond is a $990 clean price plus the $15 accrued interest, which gives us a total of $1,005. Here's another example where we're going to look at calculating the coupon rate itself. So let's say Large Industries sells bonds for $1,065.95. Again, we can assume that this is a $1,000 bond. So just by looking at this, you should be able to determine, hey, this bond is selling at a premium. The life is 9 years and the yield to maturity is 7%. Coupons are paid semi-annually. What is the coupon rate on the bond? So to solve this, we're going to go from left to right in our calculator. We're going to go 18N, which is the 9-year life of the bond times 2 because they're semi-annual payments. So 9N. Then the interest rate is the yield to maturity. However, the yield to maturity is 7% annually. So we have to cut that rate in half and input 3.5 IY. We'll put 1065.95 plus minus as a PV and $1,000 for the FV and then compute PMT. And you should end up with $40. This is a semi-annual payment. So $40 times 2 is a total of $80 in payments received. And that $80 on a $1,000 par value is an 8% bond. This should make sense because the bond is selling for $1,065.95, which is more than the $1,000 par value. If the yield to maturity is 7%, our bond must pay more than 7%. We just don't know how much more. Well, after doing this, we know that it's 8%. So now let's look at bond yields. Remember that the coupon rate is the fixed rate that's printed on the bond, and we only use that to determine the bond's periodic coupon payments. So after that, throw it away. The yield to maturity, or YTM, is that discount rate that's derived from the market, reflecting the bond's expected return if held to maturity. The yield to maturity accounts for the bond's price, market conditions, and the riskiness of the cash flows. The yield is essentially a market-determined rate. The yield to maturity is influenced by various market forces, including the bond issuer's creditworthiness and other financial assets that are competing for that investment. Remember, other bonds of similar risk, or other investments of similar risk. The yield to maturity, in essence, is a return, and that return, you'll see when we do stock valuation, includes a risk-free rate and then premiums for factors like the length to maturity and the default risk. In essence, the yield to maturity is based on the bond's market price, and it reflects an agreement between the buyer and seller. If the buyer and seller don't agree, we don't have a deal. Here's an example of where we can now calculate the yield to maturity. Let's say Coca-Cola sells a $1,000, 7-year, 1% semi-annual bond for $752.06. What's the yield to maturity? Using our calculator from left to right, 14N, we're going to skip IY because that's where we're going to calculate. 952.06 plus minus PV, 5 PMT, which is 1% of $1,000 divided by 2, right? 1% of 1,000 is 10, cut that in half to give us 5. $1,000 future value, compute IY, you'll end up with 0.8655. That's a percent, but that's semi-annual. So what we have to do is multiply that by 2 to discover that the yield to maturity on this bond is 1.73%. We should then check our answer for logic. If the yield to maturity is 1.73%, how does that relate to the coupon rate on the bond? Well, it's higher. 1.73% is the market rate. The bond pays 1%. Therefore, Coca-Cola has to offer investors a discount to buy that bond. So that $1,000 bond should sell for less than $1,000. And guess what? Yes, it does. It sells for $952.06. Let's close out this section with a couple of in-class problems, starting with ICP 10.1. In this question, a metallical bond carries a coupon rate of 8%. It's payable semi-annually, has 9 years to maturity, and sells at a yield to maturity of 9%. So we have 3 requirements. What interest rate do the bondholders receive? What's the price that the bond sells for? And what will happen to the bond if the yield to maturity falls to 7%? For requirement 1, to calculate the interest payments the bondholders receive, we'll simply take the $1,000 face value, multiply by the 8% coupon, and then divide by 2 payments per year to end up with $40. So the total annual interest payments will be $80, but broken up into semi-annual coupons. At what price will the bond sell? Well, let's use our calculator. And starting from left to right, we have 18N, calculated as 9 years times 2 semi-annual payments per year, and then 4.5 IY. So we have to take the yield to maturity of 9% and divide it by 2 because of the semi-annual payments. We're going to calculate the PV, so skip it. 40 PMT, 1,000 FV, and compute PV, and you should end up with a bond price of $939.20. And now what will happen to the bond price if the yield to maturity falls to 7%? All we have to do here is replace IY with 3.5 instead of 4.5 and recompute the PV. Everything else stays the same. We should get 1065.95. So if the yield to maturity is 9%, the bond will sell at a discount. And if the yield to maturity drops to 7%, the 8% coupon bond will then sell at a premium. Here's another one, ICP 10.2. This one is an escalating coupon. So let's say that Involvi is planning a 9-year bond issue with an escalating coupon rate that works like this: 4% for the first 3 years, 5% for the next 3 years, and 6% for the final 3 years. And if bonds of similar risk are yielding 5%, what is the current price of that $1,000 bond? The easiest way to think about this question is to first draw a timeline that shows the cash flows of the coupons and the final payment to be received at maturity. So if we draw this out, we have at the end of the first 3 years, $40 coupon payments. At the end of each of the next 3 years, 4, 5, and 6, a $50 coupon. At the end of years 7 and 8, we have the $60 coupon. And then at the end of year 9, we have the $60 coupon plus the face value of $1,000. So the easiest way to solve it then is to use the cash flow function in your calculator. So we have CF0 is 0, C01 is 40, with F01 of 3. C02 is 50, with F02 of 3. C03 is 60, but with a frequency of only 2, because that third coupon payment has to be combined with the $1,000 face value at the end of year 9. So C04 is 1,060 and F04 equals 1. So you have 4 cash flow streams, not 3. That's the trick with this one. If we hit the NPV button, and for the interest rate we enter 5, and then press the down arrow and compute NPV, we should end up with 993.09. All right, now let's talk about yield curves. So here's where we're going to use a yield curve to show the term structure of interest rates. We'll look at changes in the yield curve shape and the importance of the shape of the yield curve. And included in this conversation will be corporate versus government bonds and some factors that influence the slope of the curve. The term structure of interest rates refers to the expected yields on bonds across different maturities. If you look at the little graph here, you can see that on the horizontal axis we have time, and on the vertical we have yield, basically the percentage. And you can see that as time progresses, so the longer the maturity of a bond, guess what happens to the yield? You expect a longer term bond to pay more. This shouldn't be unexpected. Perhaps if you have been looking at making investments in something like a GIC, Guaranteed Investment Certificate, or something like that. If you buy a 1-year GIC, it pays lower interest than a 3 or 5-year GIC. So, ergo, the longer the term, the higher the rate. As it turns out, there's a reason why when it comes to bonds, that the longer term gives you a higher return. Part of that is because of the risk associated with that time frame. There's no guarantee that the company is going to be around or be able to support those coupon payments. So because of the uncertainty involved with more time, the investor takes on additional risk, and therefore they have to be compensated. So when we plot that graph with the yields on the Y and the maturities on the X-axis, that line that results is called the yield curve. It's not a straight line, it's actually a curve. And that represents the relationship between bond yields and their maturity periods. Constructing the yield curve is actually pretty simple. It's created by plotting a whole bunch of yields of government bonds with their various remaining maturities. So it's literally just a plot. This curve is often referred to as the risk-free yield, since government bonds are considered safe, right? Investments with low default risk. And again, what happens is the typical yield curve slopes upward, which means it's positive, because longer-term bonds usually offer higher yields to compensate for increased risk over time. If we look at corporate versus government bonds, corporate bonds will offer higher yields compared to government bonds, and that's because of the greater risk associated with corporate issuers. They're not backed by an unlimited supply of money that can come from taxing people and printing money. Corporations are actually limited in the amount of cash they have access to. So while government securities are backed by the state or the province or the federal government, they're considered highly secure. Corporate bonds will then vary in risk based on the company's financial strength and the bond's term. There are actually different shapes to the yield curve. So what we've just looked at is called a positive or normal yield curve. Here's where investors will expect higher returns for longer-term bonds due to the increased risk of holding the bond to maturity. We often observe this during economic expansion with rising interest rates, along with anticipated interest rate hikes. A flat curve is when there's very little difference between short-term and long-term yields. We often see this during transitions between normal and what we'll see are inverted yield curves, or due to low interest rate environments or unconventional monetary policies that basically cause a short-term interest rate to be very similar to a long-term interest rate. And then there's the inverted yield curve. You may have heard of that in the news. This is where investors expect lower returns for long-term bonds due to increased risk. So that means the short-term yield is actually higher than the long-term yield. It's the opposite. And we usually see this during recessionary periods or when we're expecting interest rate drops. So here's an example of some actual yield curves. The blue line is a normal positive yield curve from around August 13th, 2018. You can see that as the time to maturity increases, the yield also increases. Then the orange line represents a yield curve for about July 12th, 2019, where we see an inverted yield curve where short-term bonds actually have a higher return than, I would say, 1 to 7 year bonds, and then the 10-year bonds start to pick up again. And then in August 2019, it dropped even further, still inverted, but the rates on those long-term bonds all dropped. So here we saw a shift of the yield curve in a 1-month period from July 2019 to August 2019, following the same general shape, but just a downward shift of the entire curve. This graph shows some elements of inversion of some recent yield curves. So we can see that on each of these 3 dates, January 2nd, 24th, and 21st, the 3-month bonds are all pretty much the same in terms of their yield. But when you look at a 1-year bond, on January 2nd and January 24th, they were still similar. But then on February 21st, a 1-year bond experienced a significantly lower expected return. And we look at the 5-year bonds, that's even lower still. So what's interesting is that the January 24th curve saw an inversion when it came to bonds between 1 and roughly, let's say, 8 years. And then for 8 years and older bonds, the expected return was higher. But yet on February 21st, the expected return on longer term bonds never became higher than the 3-month or the 1-year bonds. So this suggests that there is some concern on what the economy might look like. So for example, on January 24th, the sentiment was, we think maybe that the next 1 to 5 years isn't going to look very good. But after that, things might recover. But then that sentiment changed around February 21st, where now the expectation is that now that 1 to 5 year period, we need to extend to 10 years. There's a lot of uncertainty around that period of time, and we don't know what to expect. And therefore, we're not going to lock ourselves in to a 10-year bond. Here's a graph I found of the Canadian yield curve, fairly recent. So on October 23rd, 2024, we can see that we've got a little bit of inversion going on here. The blue line is the most recent. The green dotted line would have been a month ago, and the orange 6 months ago. We can see that all 3 lines show an inverted curve. Short-term bonds today are expected to yield around, let's say, 3.8%. A month ago, that was a little over 4%, and 6 months ago, that was a little over 5%. And then the longer we look into the future, the lower the expected return on those bonds. So there's something going on, and this suggests that we might be looking at some recessionary pressures. In terms of factors that influence the slope, as we've seen, the yield curve slope reflects the difference between the short-term and the long-term rates. This captures investors' expectations about future interest rates and reflects uncertainty over economic conditions, which is what we've just seen. The economic outlook for the next 5 to 10 years perhaps is looking a little bleak. We won't know until it actually happens, but this is considered to be a reasonable predictive indicator. So for example, those yields on longer term bonds can account for investors' expectations of how the central bank interest rates might change over time. And as interest rates drop, so will yields. The last section of this chapter deals with the risks of interest rates and default. So we'll look at things like interest rate, default risk, and other types of bond risk. I'll look at factors that can impact default risk. I'll look briefly at bond laddering, discuss bond ratings and agencies, and then reaffirm how to calculate the yield to maturity on a bond. All right, so when it comes to the risks associated with bonds, there are a number of different kinds. The first is credit risk. And that's simply that the risk that the bond issuer may fail to meet the payments, their commitments, leading to higher yields as compensation. So government bonds typically have low credit risk due to their stability, and corporate bonds, as we said before, depending on the creditworthiness of the company, will have to pay higher coupon payments, offer higher yields to investors to compensate for risk. The second type of risk is liquidity risk. So this is the risk that the bond may be difficult to sell, resulting in higher yields to compensate for reduced liquidity. So government bonds will typically have high liquidity except during extreme economic distress situations. There's a call risk. So that's the risk that the bond could be redeemed by the issuer before its maturity. And this often happens when interest rates drop. So if the company has issued a 7% bond and suddenly the rates on the market drop to, let's say, 6 or 5%, well, why should the company be paying 7% on a bond when it can call those back, reissue them, and pay 5%? And as long as that's in the bond indenture, then there's nothing that the bondholder can really do about it. So they have to be compensated slightly for that type of risk as well. The fourth type of risk is reinvestment risk, and this relates to call risk. So this is what happens when investors face unfavorable reinvestment opportunities when their, let's say, 7% bond is called and replaced with a 5% bond. So this could cause some financial losses as well. The next risk is term risk. This is where investors demand higher returns for longer term investments because of the exposure to rising interest rates, and that could lower the value of the bonds. Term risk is measured by the term premium. Interest rate risk is another one. So bond prices fall when interest rates rise, and so that poses a market risk for fixed income investors, and this reaffirms that longer term bonds are more susceptible to that risk. Time naturally introduces uncertainty, and with uncertainty comes risk, and with the risk comes a premium. Then there's default risk. This is the risk that the issuer may miss payments or default entirely. The Government of Canada Treasury securities are basically free of default risk, while corporate bonds can carry varying levels of default risk. I actually had an investment quite some time ago. I can't even remember the name of it, but it was a bond and it defaulted. So it does happen. Now let's talk about bond ratings. Bond ratings help investors evaluate the different risks of bonds by assessing the issuer's ability to meet those financial obligations. The rating agencies will publicize this information about the issuer, assign a quality grade to the bonds that reflects their likelihood of default. So the three most common and well-known rating agencies are Fitch, Moody's, and Standard & Poor's. They all use similar ratings. AAA is the highest quality, AA is the next level of quality, triple B, etc. So here's where we can see how they're similar. Where we can see they all have AAA ratings for almost zero risk. S&P and Fitch have triple B, whereas Moody's calls it a BAA. That's some risk and more risk if the economy declines. Double B versus BA, speculative, risky, etc. And as you move down the ladder, when you get to sort of C and D level bonds, those are often called junk bonds. It's not that they're junk. It's just simply that they become more speculative. Here's a snippet I took a few years ago of a TELUS bond. This 3.3% annual bond that would have matured around May 2029 has a coupon rate of 3.3%. Its yield is 1.879%, so that's the yield to maturity. We can see that it trades at 110.50, so 110% of face value, which makes sense because a 3.3% interest rate is higher than the yield to maturity. And this is rated as basically triple B, H, whatever that is, triple B plus. So some risk, more if the economy declines, but otherwise is, for a corporate bond, a relatively safe bet. So the bond ratings, in essence, reflect the agency's judgments on the issuer's future and their ability to pay and its growth prospects. There is really no fixed formula to calculate bond ratings, so analysts will use key financial ratios like debt ratio, earnings to interest, or return on assets to come up with their ratings. Now we'll move to bond returns. So now we'll look at how bonds generate returns for their investors. So the first is generating interest income, and that comes from the coupon rate. And again, the coupon rate is influenced by the current interest rates, the maturity, the credit rating of the issuer, etc. And these are also impacted by inflation. So if inflation rises during the bond's term, the attractiveness of the realized returns can diminish. Because when you have a bond that's a fixed rate and inflation increases the interest rates, then what happens is you have a yield to maturity that can get either close or surpass the coupon rate that's built into the bond. The other return on a bond comes from generating capital gains. So you've got interest and gains. Investors who don't sell bonds until maturity can sell them on the secondary market through brokers. This happens all the time. If you have a discount brokerage firm, you can go and you can purchase bonds. You can have a situation where you sell that bond for a capital gain or a capital loss. A capital gain results when the bond is sold at a premium or above its face value, and a loss occurs when the bond is sold below its face value. So let's look at a couple of in-class problems relating to bond returns. Here in ICP 10.3 on October 24th, MF Breweries borrows funds by selling some bonds with $1,000 face value. At that issue, the bonds had 10 years to maturity and bore a coupon rate of 16%, paid semi-annually on March 31st and September 30th. At the time, the going yield on the bonds was 14%. And in October of 2028, interest rates fall, and the yield on bonds of the same level of risk as MF Brewery bonds drops to 12%. So we've got some requirements here that we'll look at individually. For requirement 1, to determine the bond price at October 1st, 2024, let's use our calculator. 20N, 7IY, 80 PMT, that's the $1,000 face value times the 8% coupon, 1,000 FV, compute PV, and we'll end up with 1,105.94. Just that easy. For requirement 2 in the amortization table, this is what it should look like, and you want to see if you can duplicate that manually in Excel just to refresh your skills. For requirement 3, to determine the bond price at October 1st, 2028, with the revised yield to maturity, we have to enter 12N because that's how many payments are left, 6IY, leave the payment at 80 and the future value at 1,000, compute PV, we get 1,167.68. So that's how much we would sell the bond for 3 years after we purchased it. For requirement 4, to determine the interest return, all we do is we take the $80 coupon, we multiply by 2 semi-annual payments times 4 years. That gives us $640 in total interest return, and we divide that by the $1105.94 original purchase price of the bond. That gives us a return of 14.47%. For requirement 5, the capital gain return, this is the difference between the price we sell it for in 2028 minus the price we purchase it for in 2024. So $1167.68 sale price minus the $1105.94 purchase price is a net gain of $61.74. We then take that $61.74 gain, divide by the original purchase price of $1105.94, and that gives us a capital gain return of 1.4%. For the return on investment, we take the $640 interest return plus the $61.74 capital gain return to give us a total return of $701.74. We take that $701.74 total return divided by the $1105.94 purchase price, and that gives us 15.86%. We can also confirm it with our calculator. It'll be off a little bit due to the rounding that we've included in some of our other numbers here, but the calculator will give us an exact result. If we put 8N for the number of periods, if we put the original purchase price of $1105.94 plus minus PV, the $80 coupon, and then the future value of $1167.68, and then compute the IY, we end up with 7.76%. Remember, that is for semi-annual periods, so we multiply that by 2, and the total return is 15.53%. So just a little off the rounded calculations that we just did. Let's look at a second one, ICP 10.4. So 5 years ago, you purchased an 8% coupon bond for $975. You sold the bond today for $1,000. What's your rate of return on the bond in each of the following situations? Where all the coupons are immediately spent when received, so you don't reinvest the coupons. Where the coupons are reinvested in your bank, which pays a 1% interest until the bond is sold. All coupons are reinvested at 8.64%. And then we can also use the yield to maturity method to solve requirement 3. All right, I think you'll find these Pretty easy to solve, actually. So for requirement 1, if we want to determine what the return is if we spend all the coupons, the first thing we want to do is determine what the annual coupon is, and we can calculate that as the face value of $1,000 times the % coupon rate gives us $80. Then all we want to do is determine, well, how many coupons did we receive over that 5-year period, which we don't reinvest? So $80 times 5 years is $400 in total interest payments. So it means our total cash flows for that 5-year period is the $400 in interest we receive plus the $1,000 we receive for the face value at maturity. So it's $1,400. So to determine what our return is, we can just use our calculator and enter 5N, 975 plus minus PV, because that's what the price of the bond is when we purchased it, 0 PMT, because those coupon payments are not reinvested. And then the future value is $1,400, which is the sum of the uninvested coupons plus the face value. If we compute IY, 7.5%. For requirement 2, if we decide that we're going to reinvest those coupons at a low interest rate of 1%, we want to determine what the future value of those coupons will be. 5N, 1 IY, 0 PV, 80 PMT, and compute future value 40808. So those reinvested coupons at 1% will grow to $408.08. After 5 years, the total cash flows will include the future value of those coupons of 40808 plus the $1,000 par value to give us a total of $1,408.08. To calculate what the return is, we already have 5N in the calculator, so we can leave it. The PV should be 975. The payment is still 0, so all we do is replace the future value with 1,408.08, compute the IY now, and we get 7.63%. For requirement 3, if we want to reinvest those coupons at a rate of 8.64%, we'll do the same thing. The future value of those reinvested coupons is calculated as 475.35 by starting from left to right, 5N, 8.64 IY instead of 1, 0 PV, 80 PMT, and compute the future value, 475.35. The total cash flows after those 5 years is that 475.35 in reinvested coupons plus the $1,000 par value, 1475.35. If we put that in as a FV now, 5N, 975 plus minus PV, 0 PMT, 1475.35 future value, compute IY, 8.64%. And if we want to prove this using the YTM approach, which is simply then taking the cash flows and using the calculator fully, 5N, 975 plus minus PV, 80 PMT, and 1,000 future value, compute IY, 8.64%. And that's it. The last concept relates to bond laddering. So this is a real simple investment strategy where investors will divide their total investment across multiple bonds with staggering maturities. This would make sense on a way to riff out your RRSP. So as you get closer to, let's say, retirement, and you want to start drawing your retirement funds out, you may convert some of your equity securities into bonds and then have bonds with staggered maturities so that you will generate cash by selling bonds with shorter maturities and then take those funds out of the account. So there's some benefits to bond laddering. The first is stability from short-term bonds. They're less sensitive to market risks, offering stability within the portfolio. Of course, they come at a lower return. And then you get higher returns from long-term bonds. That compensates for the risk associated with time and interest rate risk. Another benefit is that you can balance that risk-return relationship. So by having both short-term and long-term bonds, the ladders can help achieve superior financial returns compared to investing solely in short-term bonds. And the final benefit is risk reduction. So including shorter-term bonds in your portfolio can mitigate the overall risk, making the strategy less risky than investing entirely in long-term bonds. So it's all about, in essence, diversification of risk. And then finally, in sum, there's that inverse relationship again between interest rates and bond prices. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. And the bond values are affected by prevailing interest rates, maturity periods, the taxability of interest. This is probably more relevant in the United States, where certain types of bonds, municipal bonds or state bonds, may be interest-free to encourage investors to purchase those bonds, which help in infrastructure development and projects and those kinds of things. So there are some bonds in the US which are either reduced tax or tax-free. Other factors that affect the ratings are, of course, the issuer's credit standing and then the call risk. And that's it for Chapter 10.